Hi all, welcome to this 9-step video series on financial modeling in Excel step by step. If you've ever wondered how analysts at JP Morgan or top firms like that create financial models that drive billion-dollar decisions, you are at the right place. Over the next 9 videos, I walk you through every critical step from building the structure and analyzing historical data to projecting revenues, cost, cash flow analysis, and even balancing the balance sheet. As a former JP Morgan analyst, I've built countless models and I know the importance of getting each step right. In this first video, we're laying the foundation of creating the structure of the financial model. Ready? Let's dive in. Hello friends, welcome to this step-by-step tutorial on financial modeling in Excel by Wall Street Mojo. I am Dheeraj Vaidya and I will be your guide as we build this financial model from scratch. So if you're learning financial modeling for the first time and you would like to figure out, how it exactly works, this is the right place. So in this session, we're not just going to talk about theory as such, we are going to take this whole financial modeling session in an Excel template that I have prepared for you. So by the end of this tutorial, you'll have a hands-on experience on how to build this model completely in a fully integrated way, right? So please note, this is a beginner's model and a lot of assumptions which we have taken here to create these models are very, very basic. But the idea here is that, if you are new to financial modeling, this will give you a good idea on what exactly this is and how integrated three-statement financial model is built, right? So before we get started, you will need two things. The first is that we have built a case study on financial modeling, which you will need as default, so that when we go through this case study step by step, you would know what to do. So this is the case study which I am referring to. You've created this case study here. I'll come to the contents of this case study, but I would like you to first download this, right? So this is a case study about Apex Solution, a IT company, and you have to basically project the financials and create a financial model for this company, right? So we have this case study created, and you would need access to this in order to create the financial model, right? The other thing that you will also need is this financial modeling Excel template. So this is a without solution sheet, and I have already populated the income statement balance sheets for Apex Solution. As you can see here, the historical data is already available with you, and with the help of case study and the step-by-step instructions, we'll start creating the financial model, right? So once you complete your financial model will look something like this, where your income statement will be fully complete with forecasts, right? The balance sheet will be fully complete, right? And the cash flows also, and all the other aspects like the depreciation, working capital, and debt schedule will also be fully complete. So that will be the end objective of creating a three-statement financial model. But for now, we would need the without solution sheet where all the things are empty. So the idea here is that I'll provide step-by-step instructions and I'll do the same in front of you, and I would expect you to do it along with me, right? So now let's get back to the steps which are mentioned here for creating the financial model. So here broadly I've divided this into 9 steps. First is creating the structure, then analyzing the historical financial statements, projecting revenues, costs, then depreciation, working capital, completing cash flow statement, then projecting debt, and then integrating everything. The important thing for you to note here is that this financial modeling is not a linear approach. A linear approach will be that you first forecast the income statement and then go to balance sheet and then forecast the cash flows. In fact, here we will be moving all over the place. Like, for example, when you look at this step number 3 and 4, we are projecting revenues and costs, right? And then we are also projecting depreciation, which is leading to some of the items in the balance sheet. So this is where, we stop working on the income statement, right? And then we move directly to the working capital. Here again, instead of then working on the balance sheet, we directly move to the cash flow statement, as you can see here. And then finally, we come to debt. which is again a balance sheet item. And from the debt, we also get the interest expense, which is again an income statement item. So a lot of things are kind of integrated. So it's not a linear approach like the way it is shown here, but it will be divided into different steps. Okay, so you'll understand what I am saying in a moment as we discuss each of these steps. So let's get started with step number one, that is creating the structure for financial model. Okay, so we'll target this one, but before that, we'll start looking at the case study, and in that context, we'll solve each of these steps one by one. Okay, so let's get started here. Let's read this executive summary. The executive summary tells us that we are talking about Apex Solution, which is a leader in global technology sector. Okay, and there are three portfolios products for Apex Solution. The one is software, then the hardware, and IT services. Now, what is kind of expected? You have more details about Apex Solution, but at the end of the day, you are going to project the financials of this company, Apex Solutions, right? And broadly, we understood that it is divided into three different segments. So a lot of companies have different segments, or segments could be based on geographies as well. Here it is clearly mentioned. One is software, the other one is hardware, and the third one is IT services. Okay. Now we've been provided with more details about each of these segments, right? Like, for example, software, Apex Solution has robust software products designed to streamline business operations across various industries. And it could be enterprise softwares, cloud based solutions, or customized software development. Hardwares are related to servers, networking equipment, computing devices, and peripherals. And IT services are basically IT consulting, cloud services, and cybersecurity solutions, and managed IT services as well. So these three segments are there, right? Now, the thing is that we who are creating the financial model are going to step into the shoes of a equity research analyst at Capital Partners. Okay, so that's the objective. You are going to work as an equity research analyst at Capital Partners, and your job is basically to create a financial model for Apex Solutions. Okay, so here we have been provided with more details on what equity research firm typically does. But imagine you are approached by your senior analyst, and he has asked you to create the financial model from scratch. Okay, so with that, you get started with the steps which I discussed. The 9 steps. So we'll do that one by one. So the first step is basically to gather and organize all the relevant financial data from Apex Solutions annual reports, right? So when it comes to creating a financial model, what we do is that we start thinking of the financial data. Where will it come from? The typical approach is that you go to the annual reports, SEC filings, and find the financial data like the income statement, balance sheets, and cash flow. So this is where we have already provided this to you. Income statement data, right? We have also provided the balance sheet data with you, and the cash flows here we didn't need. To simplify, we haven't provided those details with you, right? Now, coming to the discussion of step number one, that is the structure of a financial model, right? So once you have the financial data with you, you have to put that in a very systematic fashion in the Excel sheet, which I've already done for you. But the idea here is that you have to have a well formatted financial model like the way it is here, right? So you may want 3 years or 5 years of projected data, I mean that historical data with you, so that you can do analysis on that data. So the structure would mean you have income statement, balance sheets, cash flow data with you in appropriate format. So as you can see here, the format is analyst friendly format, which means that if you want to analyze this company, right? So you would like to understand what are the gross margins, what is earnings before interest, taxes, depreciation, and amortization, what is EBIT. So a lot of companies do not provide a very systematic representation of the income statement. So here we have that systematic structure in place, right? So this is what I meant by creating the structure for your financial model. Another thing to note here is that when it comes to the structure, a lot of financial analysts have different tabs for each of these objectives, like income statement separate, balance sheet separate, cash flows is a separate thing, right? And then we have supporting schedules as well. We'll come to these schedules one by one, but for now, what I meant was each sheet has a different objective. The other analyst, which I have seen very low in number, but what they also do is they create a full financial model in a single sheet. So a single sheet will have all the details of income statement, balance sheets, and cash flows, and all the other details as well. So I feel that that's more complex because you will struggle to find the objective of each of these areas within the single sheet, and it goes deep into a single sheet. Like for example, this may run into 800, 900 rows, and it will be very difficult to debug as well because of that. So I would prefer that you create a different tab for each of these sheets, right? So that's about the structure. Another thing that you need to take care of here is the color coding or the formatting part. So when we look at these numbers here, these are constant numbers, right? These are actual factual data, historical data. So this has to be color coded in blue. So let me put it here. Blue is basically for constants, okay? All right. The next thing that you need to understand is that there are formulas, right, written here. Like, for example, sum formula, which is a sum total of these three. Formulas are usually black in color. So, let me write this here. Black is basically for the formulas. Okay. So, that's another important aspect of financial modeling, color coding. And there is third color coding as well, and that's basically green color coding. And basically green, you can use or choose any type of green as such. This is basically the links to other sheets. So what do we mean by links to other sheets? I'll just give you an example here. Like for example, if we have let's say depreciation number, okay, it's coming from this sheet, depreciation and capex. Okay, so when we are linking it from here to, let's say, here, okay, something like this, then it has to be green color coded. Like for example, whatever I'll put some number here, it should be green in color so that I know that this is coming from another sheet like this. Okay, so please understand that color codings are super important, and when it comes to color coding, this is kind of industry practice. Blue is for constant, black is for the formulas, and green is the links to other sheets. Okay, so we'll follow these nomenclatures and this standard practices in our model as well. Okay, so with that, I hope you understood the first step regarding the structure of the financial model. It's actually the hardest step because you will have to navigate different annual reports, copy and paste the data in this format, which is the analyst friendly format, color code them, put them in different sheets, right? So this is very challenging, and that's why for the first model, we have already given this thing for you. Okay, we will continue our discussion on creating the financial model in Excel step by step. So in our previous video, we completed the first step where we created the structure of the financial model. And you remember you have downloaded this template, that is this financial modeling template without solutions, and you also have the case study with you, right? So we already did the first part where we assume that we have the historicals in place and it has to be in a very standardized format like the income statement, balance sheets, and cash flows, etc, right? So with that in mind, let's now look at the second step. And what's the second step in financial modeling? Second step in financial modeling is analyzing the historical financial statements. Now, this is super critical because on the basis of what you see in the historicals, basically you are going to project the financials of the company, right? So in order to analyze the historical financial statements, let's go back to this template. Okay, so first thing first, when it comes to analysis part of it, we start with the income statement, and we'll try to figure out how much has been the profitability of the company, what are the costs, what are the margins. And then there are analyst friendly terminologies like the earnings before interest, taxes, depreciation, and amortization, that is EBITDA. And then we have EBIT, earnings before interest and taxes, and then we have earnings before taxes and net income. So from profitability point of view, we look at various margins, right? One would be the gross margins, then we look at the EBITDA margins, EBIT margins, EBT, and net income margins. So let's do that. I'll just scroll down, okay? And I'll write all of these here. Gross margins, okay? Then we need EBITDA, margin. I'll come to the calculation part of it, but let me just write it down. EBIT margin, then we have EBT margin, earnings before taxes margin, and then we have net income margins. Okay, so these margins will help us understand how the profitability of Apex solution has been historically. Okay, so how do you go about calculating the gross margins? The gross margins is nothing but, total revenue minus total cost, that operating cost, which can be directly associated, right? So with that, we have the gross margin in absolute amount. So for actual one, we have $13,000 million, right? So a gross margin would be, when expressed in percentage, it will be 13,000 divided by 25,500. Okay. So let's now calculate the gross margin. So gross margins will be equal to 13,000 divided by 25,500 for actual one. So it comes out to be 51.0%. I'll copy and paste it for the other 2 years as well. And we see that it's 50.9 and 50.8% for the other 2 years, actuals 2 and actuals 3. Now let's look at EBITDA margin. So EBITDA margin is earnings before interest, taxes, depreciation and amortization divided by total revenue. In fact, all the margins here, each of these numbers will be divided by revenue so that we know how is the profitability at that level. So let's look at EBITDA margins. EBITDA margins will be equal to, EBITDA is 9,000 divided by 25,500, and we get this as 35.3%. Let's copy and paste it for the other 2 years. So it seems like it's pretty much constant, right? Let's look at EBIT margin. So EBIT is equal to how much? 7,800 divided by 25,500. So it comes out to be 30.6%. I'll copy and paste it to see how much it is for the other 2 years. 30.6, 30.8 and 30.9. Let's look at the margin at EBT level, earnings before taxes. Okay. So here it comes out to be, EBT is 5,700 divided by 25,500. And this is 22.4% and 24.8 and 26.8%. Okay. And finally, the net income margin. This is again very important because usually this is something which everyone tracks. So profitability margins or net income margins or net profit margins, it's one and the same. Okay. So 4,375 divided by 25,500, and it is 17.2, 19.0 and 20.5. So as we see that the profit margins are increasing over the years, right? So it's a healthy trend. Okay, so this is one part where we look at the historicals and how it has been performing. And the other thing that you can also look at is the balance sheet ratios. Okay, and the balance sheet ratios are basically some of the ratios from liquidity point of view, like the current ratio or the quick ratio and the cash ratio. And then you can also look at how is the leverage, right? Leverage would mean how much is the proportion of debt to equity, right? So that will give you how levered the company is, how much the company is relying on external debt. And the other thing also you can look at is how much is the return on equity or ROE. So let's try to calculate each one of them. So let's start with the liquidity ratio. Okay. Liquidity ratios would, as I said, we'll start with current ratio, and then we'll calculate the quick ratio, and then finally the cash ratio. Okay. So what does this current ratio actually give? Current ratio is nothing but your current assets divided by current liabilities. Okay. So what would this ratio gives us is that how, if your current assets are greater than current liabilities, that means you are fairly liquid, meaning that you'll be able to survive your business for 1 year just on the basis of your current assets. So let's look at how much is the trend. Current assets here is 5,740. What's the current liabilities? 2,200. So this is coming out to be 2.6, right? So 2.61. So what this means is that usually when it comes to current liabilities, these are the liabilities which you have to pay within the year's time frame, right? So, and current assets are those assets which you can liquidate and convert into cash within a year's time frame. So your current assets are much greater than current liabilities, and therefore you are fairly liquid as far as the first actual years go. Let's look at the other 2 years. It's 2.65 and 2.67. So fairly liquid. Let's look at the quick ratio now. So what is quick ratio basically is that I'll just show you with this example. So here, when we looked at current ratio, we included all these three terms, right? But when you look at this inventory, now inventory is the farthest from the liquidity point of view. What I mean by this is that the inventory could be raw material inventory, right? And raw material will have to be processed. It has to convert into finished goods, right? And then finally sales will happen and then it will convert into cash. So this is fairly long process. So quick ratio would mean if want to have cash as quick as possible, what is my situation? So we will exclude inventory from that calculation. Okay, so let's do that. I'll exclude inventory and only include cash and cash equivalents and accounts receivables. Okay, this divided by your current liabilities, that is 2200. Okay, so it comes out to be 1.2. So what I see here is that at the quick ratio level also, company is fairly liquid because it excludes inventory and still it is able to pay off its liabilities, that is current liabilities. Now let's look at the cash ratio. Cash ratio is equal to cash and cash equivalents divided by your current liabilities. Okay, so here this number comes out to be 0.55. So almost 55% of your current liabilities you can actually pay off by just using your cash and cash equivalents. So again, a healthy liquidity sign as such. Okay, so this is one part where you do the balance sheet analysis and figure out how the ratios are doing historically. Then the next thing which I said was the leverage ratio. And primarily you would like to look at what is the debt to equity ratio. Okay. And let's look at debt to equity ratio. How much is the total debt here? The total debt is 2100. And how much is the total equity? Equity is 9140, right? So this comes out to be 2.30. So debt is 2.30 times equity. So this is fairly leveraged, but overall when it comes to the profitability and everything that it comes to, like the interest payments and all, the company is able to manage that. So it's fine that debt to equity is 2.30, but if it goes beyond a certain level, then it can become an issue because of the interest payments becoming higher and higher, and this will prove a dent to the net income margins. But let's see how it is for the other 2 years. 2.07 and 1.91. So seems like the company is trying to reduce its debt levels over the years, right? So this is about leverage ratio, and let's look at the return on equity as well, that is ROE. Okay, ROE is nothing but your return on equity. What is the return that the equity holders get? The returns that they get is basically the net income. So net income is the one that is uh, to the shareholders, right? So the formula for this ROE is nothing but net income divided by your shareholders' equity. Okay. So let's do that. This will be equal to 4375 divided by your shareholders' equity is 9140. So here it comes out to be, let me express this in percentage terms. This will be equal to 47.9%. And then for 53.8% and 60.2%. So ROE is increasing each year, which is a very, very healthy sign. So all in all, what we see is that when it comes to the second step, which we were talking about, analyzing the historical financial statements, it is all about, figuring out how much is the margins, how has the company been doing historically, what are the leverage ratios, liquidity ratios, ROE, and you get a good assessment of how strong the balance sheet and the income statement is, right? So as far as this company goes, it looks like, it is in a reasonably healthy position, right? So in this video, we are going to look at step number 3, that is projecting the revenues. And for that, I would like you to first go to the case study here and look at this statement, right? The objective is to create a financial model for the next 5-year period, right? And you need to incorporate management's projections and assumptions from MD&A section. Now, question is, what is MD&A? MD&A is nothing but management discussion and analysis section. So it's a typically a part of the SEC filings. Like for example, when you download a 10K report of a specific company or an annual report, they have this section where they analyze the business of the company and also give you variables on how the company may perform going forward and what they feel about it, right? So analysts like us typically pick cues from there and you know create the financial model accordingly. So here, if you look at this MD&A section, I would like you to scroll here, and these are the excerpts from the MD&A section of Apex Solution. Okay, so for the revenue, we are going to focus this part, right? Product segments part. So let's look at what this is all about. There are three segments, right? Software, hardware, and IT services. Let's look at the software first. Contributing to major part of the revenue, software segment is projected to grow at an annual rate of 20% over the next 5-year period. This growth is fueled by increased demand for cloud-based solutions, subscription-based model, and enterprise software tailored to specific instructions. So the key here is that we have been provided how the growth rate of software segment will look like over the next 5-year period. Okay, so this is 20% given here. How about hardware? Hardware segment is expected to grow at an annual rate of what? 18%. Okay, so the growth is driven by rising demand for high performance servers, storage devices, and networking equipment. Likewise, when it comes to IT services, we see that the demand will grow by 16% annually, right? So all in all, we have the numbers as in the growth rates for all the next 5-year period, and all of this is kind of available in the management discussion and analysis section. Now, sometimes this may not be available, and you will have to come to your understanding of how the growth rate will look like, right? So typically what happens is you basically figure out, how the growth rates has been historically, and you put a number according to that growth rate. So let's look at this first. Okay, for projecting the revenues, I would like you to scroll down here, right? And look at the growth rates of historical years, right? For software, how much was that? Hardware and IT services. So in order to calculate the growth rates in revenue of the different segments, I'll write this formula as for software, it will be 15,000 divided by 12,000 minus 1. Okay, so this will give me the growth rate of software segment. So when expressed in percentage, we get this as 25%. Okay, from year 1 to year 2, historically, it has grown by 25%. I'll copy and paste this formula for the other year, and then we see that, okay, now it is 23.3%. Okay, and then when we look at the case study and when we see this 20% over the next 5-year period, now this looks typically in line, right? So 25%, 23%. So obviously it seems like the software segment is growing at a faster pace, right? So here we are going to put the assumption that is 20% for the next 5-year period. Okay, so this is what we are going to do right now. We have put 20% as the growth rate, right? Now let's look at the other segment as well. Okay, so hardware, this will be equal to 10,200 divided by 8500 minus 1. This comes out to be 20% and then 20.6%. Okay, so what was the management's expectation? That it will grow at the rate of 18%. Okay, so let me put this here. You can see that, all the assumptions which I'm putting, right, manually is blue color coded, right? So 18% and so on and so forth until the next 5-year period. How about IT services? The same thing, 6500 divided by 5000 minus 1, and we get this as 30%, 23.1%. And let's see how much is management expecting in this. Management is expecting around 16%. Okay, so let's put that here, 16%, and copy and paste. Okay, so now that we know how much is the growth rate for each of these next 5-year period, can we back calculate the revenue? The revenue can be easily calculated, right? We just need to know the previous year's revenue of that segment and then increase that by the respective percentage growth, right? So we can easily do that by putting this formula like this, okay? So here we can write a simple formula. This will be equal to 18,500 multiplied by bracket open 1 plus your growth rate. What is the growth rate here? The growth rate here is 20%. So this formula will essentially mean 18,500 multiplied by 1.2, right? So this comes out to be 22,200. Okay. So if I copy and paste this formula from this to here, we'll get the increase in revenue for hardware, right? So this will work like this: 12,300 multiplied by 1 plus 18% growth rate, right? And let's do the same for IT services as well. This comes out to be 9280. So let me check the formula. This is 8,000 multiplied by 1 plus 16% growth, right? So if I add this up, how much is the total revenue? This comes out to be 45994, right? So this is the overall revenue for year one. That's the projected revenue, okay? So I'll copy this block and paste it across for all the other 4 years as well. And we get this total revenues for the next 5-year period. So this is step number 3, projecting the revenues. Step number 4, that is projecting the costs, right? So in order to do that, I'll again go back to the case study here, and then we'll discuss the cost management aspect, which is provided in the management discussion and analysis section. Okay. So Epic Solutions software segment, right? Here, maintaining the cost at 50% by streamlining product development process and optimizing licensing agreements. So what basically it is all about is that Epic Solution has 3 segments, right? So cost will be 50% of the overall revenue for this segment. Likewise, when it comes to hardware, cost will be 48%. And IT services again will be at 50%. Okay. So I'll go back now to the Excel sheet here, and we basically want to project all the costs in the income statement. So we'll get started with cost of sales for these 3 because we already know the assumption. So first thing first is we'll do a kind of a historical analysis here. We'll try to figure out how has been the cost of sales as a percentage of revenue for each of these segments, like the software, hardware, and IT services. And then we'll also try to match what the management's projections are all about, and if they fall in line or not. Okay. And based on that, we'll put these assumptions in the future as well. So let's get started here with the software segment. So first thing first, I'm linking the respective revenue and the cost, right? So here 12,000 is the revenue. Cost of sales for software segment is how much? This is 6,000 here. Okay. So I have linked these two. So cost as a percentage of sales for that specific segment is 6,000 divided by 12,000, and it comes out to be 50%. How about the margin in absolute terms? This is 12,000 minus 6,000, right? So this is 6,000, right? Million dollars. Now coming to margin in percentage, this will be 6,000 divided by revenue. So when it comes to margins, we basically divide everything by the revenue, right? So in this case, we're trying to figure out the segment margin. So we will use segments revenue. Okay. So here we get this as 50%. Okay. So now that I've done it for 1 year, I can easily copy this and paste it for the other years as well. So what do we see? Cost of sales has been 50%, 50%, and 49.7%. Okay. And we have been provided this same number, 50%, by the management as well. So we can easily put that number here, that going forward as well in the next 5-year period, this will be 50%. Okay. So now that we have cost of sales as a percentage, do you think we can calculate the software cost of sales in absolute numbers as well? Yes, we can, because we already have the segmental revenue for software, right? And 50% of that will be cost. So let's start by linking this segmental revenue first. The segmental revenue we have already calculated for software, and that is 22,200, right? And 50% of this will be equal to that software cost of sales, right? So this comes out to be 11,100, right? And when it comes to absolute margins, how much will that be? This will be revenue minus cost of sales, and the percentage will be 11,100 divided by 22,200. So it comes out to be 50%. Okay. So what I can do is I can easily copy and paste this block for all the other years as well, so as to calculate the software segment's cost of sales, right? So with this, we are done with this part. Let's now move to the hardware. So here the approach again will be very similar. It will be again, first we'll calculate the historical cost of sales for this segment, and then we'll look at the projections, and based on what we have been provided by the management, we'll put that and forecast the respective cost of sales for hardware as well. Okay. So let's do that fairly quickly. For hardware, the revenue is 85,000 and the cost of sales is how much? That is 4,000, right? So we will get cost of sales as a percentage. This will be 4,000 divided by 85,000. Okay. And absolute margin will be 8500 minus 4,000, and it comes out to be 4,500. Percentage will be 4,500 divided by 8,500, and we get this as 52.9% as the segmental margin, okay, for hardware. I'll copy and paste this for the other years as well. And what do we see? That the cost of sales actually is 47.1, 47.1, and 48%. Okay. And what have we been provided in the case study? That maintaining a stable 48% is what they want to, right? So let's put this 48% here as the assumption, right? And on this basis, we'll be able to figure out how much will be the cost of sales for hardware as well. Okay, so I'll do this pretty quickly. Let's link the revenues first of the hardware segment, which we have already figured out. So this is 14,514 for the year one. So we have the revenues, and then let's calculate the cost of sales for hardware. This will be 48% of the revenue. This comes out to be 6966.7. Absolute margin, revenue minus cost, and margin in percentage. Here it will be like, okay, so this comes out to be 52%, and I can actually copy and paste this across for all the years as well in order to find the hardware cost of sales, right? So with this, we are done with hardware cost of sales. Let's now do the same for IT services as well. Okay, so I'll link the respective revenue, 5,000. Okay, cost of sales, this is 2500, right? And let's find out the cost of sales in percentage terms. This is 50%. Margin 5,000 minus 2500, and margin at the segment level, this is 2500 divided by 5,000. It comes out to be 50%. Okay. And I'll copy and paste this for the other historical years, and we see that it's kind of stable at 50%, right? And let's see the assumptions. The assumption says that we'll maintain 50% as COGS. Okay. So we'll put the very same assumption here, 50%. Okay. 50% put, and let's do the same exercise again. I'll link the respective revenues. Okay. And 50% of this revenue is equal to cost, right? For IT services. And let's find the margins. Margins will be revenue minus cost of sales, and let's find the percentage terms as well. This is margin in absolute terms divided by the total revenue. So this comes out to be 50%. Copy and paste this block again, and we get the IT services cost of sales as well. Okay, so what's the next step? Now that we have the cost of sales for each of these segments, what we need to do next is basically link it up here within the income statement. Okay, so let me do that. This will be equal to cost of sales is 11,100 here, right? How about hardware? Hardware, it is 6966.7, and IT services, this is equal to 4640, right? So when it comes to the total operating cost, it comes out to be 22,706.7. Okay, this is for year one, and I can copy this and paste it for the other years so as to find the overall operating cost for all 5-year period, right? So this is how you can go about calculating the cost of sales, right? But when it comes to the income statement, there are other specific costs as well which are mentioned. Now let's look at SG&A expense. So for understanding that, let's go back to this case study here. And we have been provided with some more details about SG&A expense. SG&A expense are projected to remain fixed at 15% of the total revenues annually, right? So we have this number with us as to how much will this be. We have the total revenues, so we should be able to find SG&A expense, right? And do we have more details from cost side? No, we don't. So let's go back to this case study. And SG&A expense, for calculating the historical SG&A expense in percentage terms, we'll use this row, that is 60. Okay, so this will be equal to SG&A, selling general and admin expenses, that is 4,000 divided by total revenue here, 25,500. So this comes out to be 15.7 for actuals 1, actuals 2, and actuals 3. So it is 15.7, 15.8, and 15.5%. And what does the management provides information about SG&A expense? It is 15%. Okay, so I'll put this 15% here. And can we now back calculate SG&A expense? Think it should be fairly simple, right? So let's do that. This will be equal to total revenues multiplied by 15%. Okay, so this will be SG&A expense for year 1, and we can copy and paste it for the other years as well. Okay, so with that, we have also calculated the SG&A expense, right? What I want you to also do is to figure out what's the overall gross margins, because we already have the total revenues, we have the total cost, we will have this number as total gross margins, right? So we can easily calculate that, right? It's just a formula, total revenue minus total operating costs. Now, once we have this, can we calculate EBITDA? We can easily calculate EBITDA, because EBITDA is nothing but gross margins minus SG&A expense, right? So we have EBITDA for year 1, and if I copy and paste it, we have it for all the other years as well. Okay, so this was about EBITDA. Now, coming to depreciation and amortization, I would like you to just mark this as yellow. You remember, as we were talking about the steps in financial modeling not being linear. So here I'm marking this as yellow. This means this will be done later. Okay, so we will look at depreciation and capex schedule, and then we'll calculate depreciation and put it here. But for now, we will just skip this step. Okay, so the idea is not to complete the full income statement right away, because as I said, the 3 statement model actually is a to and fro between different sets of financial statements. Okay, so that's the reason why we will just skip it here as of now. Okay, so I can, however, calculate the EBIT, assuming that these numbers are going to come in the future. Okay, now let's move to the next one, that is the interest expense and the interest income. Again, this is going to come later. Now, this interest expense and interest income will actually come from the debt schedule. And if you look at the steps here, this is step number 8. This is where we will get the interest expense and interest income numbers. Okay, so as you can see, non-linear. So all of this will come and get integrated later. But for now, we will adjust the formulas in a way that it assumes that these numbers are going to come. So net interest expense will be interest expense minus interest income. Okay, so we can calculate the EBT, that is earnings before taxes, accordingly, right? So we have these numbers as well. Now, coming to the tax part of it, tax can be easily calculated by looking at how much has been the effective tax rate historically. So as we see here, we have paid taxes, right? Apex Solution has done that over the period of time, right? So we can calculate the effective tax rate, that is how much was the overall rate on earnings before taxes. So let's do that calculation here. We have this row number 62 for that. So this will be equal to tax, that is 1325 divided by 5700. So this will give us what's the tax rate, the effective tax rate here applicable. Okay, so 23.2, 23.4, and 23.6. So if I look at the average here, it comes out to be somewhere around 23.4%. So let me do one thing. I'll just use 23.4% as the effective tax rate that will be applicable for the next 5-year period as well. So I'm copying and pasting it here, right? And this is what we are going to use in order to calculate the overall tax. Okay. So let's do that here as well. This will be equal to EBT multiplied by 23.4%. So this comes out to be 3834.8. I'm copying and pasting it for other years. And let's find out the net income now. So the net income is 12553.3 for year one. Please note that we have completed the income statement, but the ones which are marked in yellow are yet to come. So this is the steps in financial modeling. We will just finish the income statement right now, but all the other things are going to come at a later point in time, right? So with that, we are done with step number 4, that is projecting the costs. All right. Now, step number 5 is all about projecting depreciation, right? And if I go back to this model here, where we looked at the income statement previously, what we saw was that depreciation was kind of left vacant, right? So now is the opportunity to actually find out how much is the depreciation for the future years. And for that, we will be using this tab, that is depreciation and capex. So these are also called as supporting schedules, right? So if you go to this index, you will see that there are these three statements: income statement, balance sheets, and cash flows. These are the primary statements. So when it comes to three statement modeling, we are saying that project the income statement, balance sheets, and cash flows. And these are called as supporting schedules, because what we are doing here is that projecting each and every line item with respect to, let's say, depreciation capex. The objective is to forecast depreciation and capital expenditure for the future years in this tab. Okay, so supporting schedule. Now, with that in mind, let's now also look at the case study if we have been provided with any more details on capital expenditure. So based on that, we'll figure out how to go about the projections, right? So let's scroll here. We have been provided with some inputs. Apex Solutions CapEx strategy for the next 5 years is aligned with revenue growth projections. Okay. So we've been provided with the numbers as well, that capital investment over the next 5-year period is 10,000, 11,500, 13,000, 13,500, and 15,000. So we have been provided with these numbers, but sometimes what happens is that these numbers may not be available to you like the way it is here. So in that case, you'll have to do the projections. You'll have to figure out how has the capital expenditure, you know, expense for the company has been historically, and based on that, you make an assumption. So here again, it's very simple. We just know these numbers. We'll just take it directly. So let me do one thing. We will we have this section here, right? Beginning PPE, capital expenditure, depreciation, and net PPE. So first thing first, what I'll do is I'll put these numbers here. Okay. Then I'll explain what's going on within this depreciation capex tab. Okay. So this is 10,000, right? Then we have 11,500. Then what else? 13,000. Then 13,500 and 15,000. Okay. So this is the capital expenditure. So if you look at a company's point of view, this is the amount of investment that the company needs to do in order to make the revenue sustainable in the future. Okay. So that's the committed capital expenditure. Now, coming to what's the objective of this depreciation capex schedule? First is to project the depreciation for the future years, and then also find out what will be the net property, plant, and equipment number. So, in order to explain what and what's going on here, I would like you to think of this equation: B A S E. Okay, base equation. Base means you have a beginning balance, right? So, in this case, you have beginning balance of property, plant, and equipment, right? Now, during the year, if you're purchasing any property, plant, and equipment, that will be A, that is addition. Okay. So, in this case, we are referring to this part as capital expenditure, right? So, this will be the addition to the property, plant, and equipment which you already own at the start of the year, right? So, we call this as capex. All right. Now, what will subtract is basically the amount that gets depreciated. right? So depreciation is a non-cash item, but you have to allocate the cost, right? So this depreciation reflects the allocation of cost from the fixed assets. So this will get depreciated. This is S, means subtract. Okay, this is depreciation here. And E is nothing but your ending balance. And ending balance here is net PPE, or property, plant and equipment. So you understand base equation? So when we will apply this equation here, we'll be adding capital expenditure because it is A here. Okay. Now what we also need is the beginning balance. Okay. So the beginning balance, the way we write the formula is, we'll link this net PPE. Where will we get this net property, plant and equipment number? We'll get this number from what? You'll get it from the balance sheet, right? So here, if you see this, this is 31400. This is net property, plant and equipment. Net property, plant and equipment means that depreciation has been removed from it, and it is the actual post depreciation number. Okay. So this is for year actual 3. Okay. So this will become your beginning balance for the next year. Okay. For year 1. So we have B, we have A. What we need is D, that is depreciation. We'll calculate that as well. And the final number will be ending, that is E. Okay. So the formula will be this plus this minus depreciation. This will give you the ending balance. Okay. So what I can do is I can just copy and paste this across for all other years as well. And net PPE formula as well. So what do we see here? Except for depreciation, we have all the numbers, right? The net PPE numbers, we have it. But once we calculate the depreciation, this net PPE numbers will get automatically adjusted. Okay, so far so good, right? Now coming to the depreciation expense. Now here what we are doing is that this is a typical IT company, right? In IT company, usually capital expenditure is not huge, and depreciation usually is a very small or insignificant number as a percentage of revenue. So usually in these type of companies, you just don't kind of make a elaborate depreciation schedule. Like, you don't look at each assets and depreciation on the basis of what's the overall gross value and the useful life, and then calculate using different depreciation methods like the straight line or the WDV method. Here, we are just taking it in a very simple way. We know what has been the historical revenue. We know what is the historical depreciation. So we'll see what the trend has been historically as a percentage of revenue, and we will just forecast on that basis. Okay. So since this is the first model, we are keeping things simple. Otherwise, depreciation schedule is a very elaborate one. And all of that we have taken it in a different course on financial modeling. But here, since this is an introductory one, we have just kept things simple, right? So let's get started here with the revenue. Let's link it up from the income statement, right? We have this number here, 25500. So this is for the actuals, and I can copy and paste this across for all other years as well, right? Now how about depreciation? Depreciation numbers, we already have this here. This is 1200, 1400, and 1700. Okay. So let's copy and paste it. And now let's find out what is depreciation as a percentage of revenue. Okay. So depreciation as a percentage of revenue comes out to be 4.7% for actuals 1, 4.4, and then 4.4. So what we can do here is that in the future years as well, we can assume that this trend would continue. So depreciation as a percentage of revenue will remain at 4.4%. Okay, so that's what I'm assuming. And please note, I'm reiterating that this is a very simplified version of figuring out what depreciation amount will be. Usually, there is a very comprehensive schedule you are expected to create based on each of the type of assets like land, building, and useful life. So we do that elaboratively, but since this is your first model, we are keeping things simple. Okay, so let's figure out what's the depreciation here. Depreciation will be 4.4% of the overall revenue. Okay. So here we get this as 2023.7, and copying and pasting it for other years, we get these numbers as well. Okay, so we have found the depreciation numbers. Now we can link it here, right? The depreciation. If we link it here, this will be equal to 2023. And what do we see? The net PP numbers get automatically adjusted, right? So the objective of this depreciation capex schedule was to figure out what is the depreciation number and what is the net property plant and equipment number. And we also needed the capital expenditure numbers, which we already were provided by the management themselves, right? So with that, we have done step number 5, that is projecting the depreciation and capex. But there is one more step that is needed here, and that is all about linking it back to the respective cash flow statement. Okay, so I am keeping this step for the later part. If you look at this step number 13, completing the cash flows, I'm keeping it for step number 7. But for now, please note that each and everything which we have found out here, like the net property, plant and equipment, this will go to the balance sheet, right? We can link it. Likewise, capital expenditure numbers, we can link it to the cash flow statement, right? And this depreciation, we can link it back to the income statement. So we can do this right away here. Now that we have these numbers, let's link this depreciation amount. Okay. So here this is. All right. So we are done with the depreciation. Now, if you look at the amortization here, we see that if you look at the balance sheet, actually, balance sheet only has fixed assets, right? And when it comes to intangible assets, it's basically zero. So there will be no amortization as such. So for amortization, we'll keep these numbers as zero for the future years. So I'll just put this as zero. And what I'll also do is unhighlight this so as to let you know that this is now fully complete. And please note that since depreciation is coming from a different sheet, like depreciation capex schedule, we see that this is color coded as green in color. Okay, so very important from a financial modeling point of view that you know the color coding and the formatting as well as we do. So this is step number 6. Today we are going to talk about projecting the working capital. So if you have directly come to this video tutorial, I would encourage you to follow these steps in this sequence. We already discussed, how we are going to go about creating a financial model in step number 1, and we discussed about the structure. Then we analyzed the financial statements, then we projected the revenues, thereafter the cost, and then in the previous video we discussed how to go about projecting depreciation and the capital expenditure. Now we are at step number 6, that is projecting the working capital. So for that, I'll again go back to this template here which we were already working on. And if you look at the index, we have this working capital tab here, right? Now let us understand what working capital means in the context of financial modeling. So typically when we talk about working capital, we say that working capital is current assets minus current liabilities. Like for example, if you go back to the balance sheet here we have the current assets and then we have the current liabilities. So basically working capital in traditional sense is designed as current assets minus current liabilities. But here what we are doing is we are talking about working capital core items like account receivables, inventory and accounts payable. So these are the three things we are looking at: account receivables, inventory and accounts payables, right? So when it comes to forecast, we will not be forecasting cash and cash equivalents here. Cash and cash equivalents will come separately in the cash flow statement. Okay, now let's go back to this working capital sheet and let's first understand what these terms actually mean. Account receivables, now think of it like money that is owed to the company by the customers for the goods or services that they have delivered on credit. So if a client is purchasing on credit, then that amount will go as accounts receivables. All right, now the second thing which we have is the inventory. So this is nothing but goods and materials a company actually holds for production or sale. So these are like raw material which you have purchased from the suppliers, or anything that you are holding currently for production or sale are classified as inventory. So inventory can be a raw material inventory, it could be work in progress inventory, or it could be finished goods inventory as well, right? So that's about the inventory part. And finally we have the accounts payables. Now accounts payable is basically the money that the company actually owes to the suppliers. So let's say you're buying raw material from suppliers, so you may not pay everything in cash, you would like to have some credit from suppliers, right? So that amount will actually go as accounts payables. Now these are the three items which are considered when we talk about working capital forecast. Now, let us look at how we can go about projecting these three. The answer actually lies in this thing called as cash collection cycle or cash conversion cycle. Now, I would like you to think from the point of view of a company, right? First, the company makes an investment. So, the investment via working capital would be in the form of inventory, right? So, company will purchase raw material and it will take some days to process the raw material and convert it into finished goods, right? So let's say it takes 30 days. So company has made an investment and it is taking 30 days for that company to, let's say, process the inventory and complete the overall process of making it as a final product, right? Now let's say the selling process has been now completed and the client has bought this product on credit. Okay, so a credit period could be 15 days, 30 days, whatever. Let me just put this number randomly as 15 days. So what's happening is that when you're making an investment in the inventory getting converted into WIP, work in progress inventory, and then finished goods, and then the selling process happens, and finally when you receive cash it is still 45 days, right? 30 days and 15 days, 45 days. So your cash is stuck in the system for 45 days, right? Now what is this payment period here? Now payment period is basically, think of it like the accounts payables, right? When you're purchasing inventory from the suppliers, again suppliers will or may demand cash upfront, but in most cases you will get a credit period also associated from them. So you will have that leeway of paying them after 15 days or 30 days or 45 days, right? So let's assume that they give you a credit of 15 days, okay, or maybe I'll just change that number, maybe 20 days. Now what happens is that when it comes to these first two items, first two numbers, right, your cash is stuck as a company, right, for 45 days. Now the cash conversion cycle formula will now become as 15 days plus 30 days minus 20 days. We are deducting payments period because someone else's cash is stuck here, right? So here it comes out to be 25 days. Now the idea here, or visualize this 25 days as, when you make an investment in your company via inventory, and it takes 25 full days to come back to the system. So that's what cash conversion cycle will actually mean to you. Now how is this related to working capital, and how can you go about projecting working capital items like receivables, inventory, and payables using this? Now it's very simple actually. So when it comes to receivables collection period as 15, you need to think about it from the turnovers point of view. See here I have written receivables turnover. Okay, now a receivables turnover formula is sales divided by accounts receivables. Okay, now what does this actually mean is that how many times during the year you are converting your receivables into cash. Okay, so let's say you're taking 15 days to do that. So if you have to actually calculate receivables turnover, what will that be? So that will be equal to nothing but your 365 days, right? So if you have 365 days in a year divided by 15, so that's the number of times you're converting receivables into cash. So that's fair enough, right? Because every 15 days you're doing that, so in a year you're doing that 24.3 times, right? Now the same we can do for the inventory turnover as well, and the payables turnover. The formulas are as like this is COGS divided by inventory, and for payables turnover it is COGS divided by payables or accounts payables. Okay, so let's calculate that as well in this case. So here it will come out to be 365, that is this link here, 365 divided by 30 days, right? So here it comes out to be 12.2 times. So you're converting your inventory into final product, and so that it can be sold. You're doing it 12.2 times during a year. Likewise, let's calculate the payables turnover. Payables turnover is 365 divided by, again, 20, and you're doing this payment to the suppliers 18.3 times during the year. So I hope you understood the logic here, and from this you can actually calculate the receivables, inventory, and payables. So let's now get started by putting in actual numbers, right? And you will understand, how to go about it. So first thing first is that for actuals one, let's calculate the receivables turnover. What is the receivables turnover? Receivables turnover is sales divided by accounts receivables. Okay, but in order to calculate that, we'll need these numbers here, right? So let's get started by doing the basic work of linking the historical numbers. So account receivables will come from the balance sheet, right? So here it is 1440. So here for the next 3 years. Likewise, let's link the inventory numbers. This is 3100 for actuals 1. So this is inventory, and let's now link the payables number as well. So here we have this payables as 2200. So we have linked the working capital numbers. Now let's link the sales and the operating costs, right? So we need these numbers to calculate the turnovers, right? So let's do that too. Here we have sales, total revenue. This is 25500 for actuals 1. So I know the sales figures for all the years, so I'm linking it across all the projected years as well. Okay, let's now do the same for the operating cost. Operating cost is how much? 12500 here. So linking it across all the years. Okay, now let's find out receivables turnover. Now receivables turnover is what? Sales, that is total revenues, divided by your accounts receivables. Okay, so this comes out to be 17.7 in this case. Okay, let's now calculate the inventory turnover. Inventory turnover is cost of goods sold divided by inventory. Cost of goods sold is nothing but operating cost in the EPIC solution. So this is 125000 divided by your inventory, that is 3100. Okay, so this is 4 times, right? And what about payables turnover? Again, it is operating cost, that is COGS, divided by accounts payables. Okay, so here it comes out to be 5.7. Okay, so interpretation wise, we understand what the turnover ratios are all about, right? Now let's find out the receivables collection period for year 1. Okay, so how much will that be? Now think in the opposite direction. When we had the collection period, we calculated the receivables turnover. Now when we have the turnover, can we calculate the collections period? So receivables turnover essentially means that you're converting your receivables into cash 17.7 times during a year. How many days are there during a year? This is 365 days. So in order to calculate receivables collection period, this will be 365 divided by receivables turnover, right? So this is the formula that I'm going to use. It will be 365 divided by 17.7. So this comes out to be 20.6 days. How about inventory processing days? The formula will remain the same, similar. This will be 365 divided by inventory turnover. Okay, and payments period will be equal to 365 divided by payables turnover. Okay, so let's now calculate the processing days and the payments period. So here this will be equal to, let's link it, 365 divided by how much? Divided by 4 here. So it comes out to be 90.5 days. And the payments period will be equal to, again, 365 divided by 5.7. So it comes out to be 64.2. So let's now also calculate the cash collection cycle. So this will be equal to 20.6 plus 90.5 minus 64.2. We discussed, it has to be a minus sign, right? So all in all, we are getting this number as 46.7 days for the first year, that is actuals 1. So now what I'll do is I'll actually make all of these numbers here as constant. This link L16 is linking directly to 365, right? So what I want to do is I want to freeze this cell so that when I copy and paste it from column number C to column number D, this 365 days should not move. So I'm freezing this and making it as an absolute reference. Okay, so putting dollar signs in front of L and front of 16, right? Let me do that for this one as well, and finally for the payments period as well. So now let's copy this and paste it for the other years as well. And what do we see here? We see that the links are working perfectly fine, right? The cash collection cycle is kind of decreasing from 46.9 days to 44.9 days, and then 42.1 days. Now, having understood this cash collection cycle, now we'll go back to the case study and we'll see if there is any inputs which are given here regarding the same. So when we look at the working capital management thing here, we have been provided with these three details: receivables collection period, inventory processing period, and the payments period, right? So let's read this. We have been provided that the receivables collection period will be around 19 days, right? So here they have provided us with this detail. Likewise, when it comes to inventory processing days, it's expected to be around 70 days, and the payments period is expected to be around 48 days. So these are basically our assumptions that we are going to use for the future years: 19, 70, and 48. So let me put these assumptions here: 19, 70, and 48. Okay, so let's see what's the cash conversion cycle in this case. It comes out to be 41 days. All right, so I'll just copy and paste this assumption for the other years as well. All right, so now what we have done is that we have found out what the cash collection cycle will be for the future. Now I would like you to think about it, that if we want to figure out the account receivables number, how can we do that? The first thing will be that first find out the turnover ratios individually, right? Can we do that? Yes, we can do that, because we already have the collection period, processing days, and the payments days, right? So we can calculate it using this formula, right? 365 is the number of days divided by 19, right? So let me put the formula here: 365 days divided by 19. So 19.2 is the receivables turnover ratio. So why I have done that? Now the formula is reverse of what we have done. So we know that receivables collection period is 19 days. So in a year, how many times are you going to convert the receivables into cash? So I have simply divided 365 by 19, right? So this will give me number of times it has happened, and that's nothing but your receivables turnover ratio. Okay, likewise, let me do the same for inventory. So this will be again 365 divided by 70, and in the third case it will be again 365, right, divided by 48. Okay, so we get this as inventory turnovers and the payables turnovers. Okay, so I'll just copy and paste it across for the other years as well, and we have the turnover ratios, that is the receivables, inventory, and payables. Now think about it. What's the formula of receivables turnover? It is sales divided by accounts receivables, right? We already know sales numbers, right? This is 45994. We also know what's the receivables turnover ratio. Receivables turnover ratio is equal to sales divided by account receivables. So can I find the missing number, that is accounts receivables here? Because I want to find account receivables, what will I need to do? I'll just copy this formula from here to here and show you that if I have to calculate account receivables, I just need to take account receivables here on the left hand side, right? And this will become equal to what? It will become equal to sales divided by your receivables turnover, right? So the formula will be just, the opposite of what we did. Okay, so using this reverse logic, we can find account receivables. So let's do that. Here, this will be equal to sales divided by account receivables, and that will give us the account receivables actual number. Okay, similarly, when it comes to inventory, we'll have it the same way. It will be equal to cost of goods sold divided by your inventory turnover. Okay, and coming to accounts payables, this will be again equal to cost of goods sold divided by payables turnover. So with this, we get the receivables numbers, inventory numbers, and the payables numbers for the first year. And I can just simply copy this and paste it for the other years to get the final number for all 5-year period, right? So this is how you can actually go about projecting the working capital items within your financial model. Okay, so this basically completes our step number 6, that is projecting the working capital. And now, in this video tutorial, we are going to discuss step number 7. So, it's all about completing the cash flows, and we'll also complete the parts of some parts of the balance sheet as well in this step. Okay, so let's get started here by going back to this template where we were looking at working capital, right? So, we have a separate tab for cash flows, right? And I would like you to understand first that when it comes to the historicals, we have not provided you with any numbers at all, right? Because that's not needed from financial modeling standpoint. But what we would need is that we would need to link all the numbers which we have projected until now. So when it comes to cash flow statements, cash flows are divided into three parts: cash flow from operations, cash flow from investments, and cash flow from financing activities, right? And if you start and look at operating activities, this cash flow calculation is actually using indirect approach of finding out cash flow from operations. So it actually starts with the net income, that's the bottom of this income statement, and then it adds back all the non-cash items whichever are relevant, right? So that's what the approach is for the indirect method of finding out the cash flow from operations, and we'll try to apply that and see how it goes. Okay, so let's get started here. This will be equal to, we have already calculated net income, right? So net income for year 1, it comes out to be 11003.2, right? Please note, interest expense and interest income will come later. That's all right, but we still have to link it now. Okay, so I'm linking the net income, right? Now, after the net income, we'll add back those items which are non-cash items. When it comes to this income statement, these are the two non-cash items: depreciation and amortization. So we'll add these back as well. Okay, so I'll link it directly from the income statement itself, and that is 2023.7, and so on and so forth. I'll just copy and paste it. Okay, and coming to the amortization, it's anyway 0, but we'll still have to link it. Tomorrow, if I may want to change this, the links should function automatically, right? So I'm adding back amortization. Now, coming to the next one, that is changes in working capital. So this is the place where, I see majority of the students get confused as to how it can be represented via cash flow statement, like changes in receivables, changes in inventory, and changes in accounts payable. So sometimes there is confusion regarding the plus and the minus sign, whether it is cash outflow or cash inflows. So please note, first thing, that the positive sign here would mean there's a cash inflow. And if there's a negative sign in the cash flow statement, it means cash outflow. Okay. Now, over to this working capital schedule where we have the receivables numbers, okay, and inventory numbers and payables numbers. Now, if you want to understand cash outflows and inflows from the point of view of cash flow statement, you need to understand this, that how the position has changed in year 1 compared to the previous year, right? So let's look at this one, receivables. Okay, it is 1960 earlier, and it has increased to 2394.2. So whether it is a cash inflow or an outflow, there can be some sort of confusion, but in order to remove all your confusion, I basically go about using a very, very simple logic. The logic goes like this. So let's say if it's an assets, right? If the assets increase, right, on the balance sheet, what will you have to do as a company? If the assets increase, then it means it's a cash outflow. All right, because you are making an investment in an asset, so cash will have to flow out in order to increase the asset. So let's let me take an example here. Let's say asset increases from 10 to, let's say, 20. Okay, so obviously if balance sheet is reporting 10 earlier and now it is reporting 20, that means you would have made an investment of 20 minus 10, right? So 20 minus 10 will be your actual investment, right? But this investment will come from where? It's basically coming from your cash. So this is basically a cash outflow. And a cash outflow is always represented as a negative sign in the cash flow statement. So this will come as 10 minus 20. So it will come as previous year minus this year. Okay. Now this is about assets. Okay. And assets, let's say if they go down from 10 to, let's say, 5, what will happen? If the assets have decreased in size, that means you would have, intuitively think of it, you would have sold the asset. Okay. If you sold the asset, then this means you would receive cash inflows, right? So from positive and negative sign, this will be again equal to 10 minus 5, right? So 5 will be your cash inflows here. Now I'm using the word assets here, okay? Now think of assets as anything on the assets side. Here we have current assets, okay? Assets are receivables, assets are inventory. So when it comes to the cash outflow or inflow, you can replace this by accounts receivables, you can replace this by inventory as well. The logic remains the same. So let's go back here and see this situation, right? The assets. So I'm not talking about receivables. I'm just independently calling this as assets. Okay. Now assets have increased from 1960 to 2394.2. Now if the assets increase, what will happen? You have to have a cash outflow situation, right? So the formula for cash outflow in this case will be equal to the previous year, that is 1960 minus 2394.2. This will mean a cash outflow of 434.2. Okay. Now let's look at the inventory. This will be equal to, again, the inventory has increased from 4000 to 4354.7. So the formula will be 4000 minus 4354.7. Assets have increased. So I need to represent this as cash outflow in the cash flow statement. So this comes out to be 354.7. Now coming to the liabilities side. So accounts payable is nothing but your current liabilities, right? Now in order to understand the cash outflow inflow for the liabilities, think of it like a loan. Okay. Now let's say a loan was 50 earlier and it increased to 100. Now what will this result in? Okay. This will result in a cash inflow, right? A cash inflow of how much? This will be 100 minus 50, because earlier you had outstanding loan of 50. Now you have outstanding loan of 100. So in this year, specific year, you would have had a situation of cash inflow, that is 100 minus 50. So whenever it is about liabilities, I think of loan. And if the loan has increased, it's a cash inflow. If the loan has decreased, that is, I would have made the payments, right? So it will result in cash outflow. So in this case, when it comes to accounts payables, I don't think of what this is all about. I just think of it like a loan. Okay. Now the loan has increased from 2760 to 2986.1. So a loan has increased. This will result in what? This will result in cash inflows. When loan increases, cash inflows. Okay. So that's the logic I'm using here. And you will never get it wrong when it comes to this type of logic if you apply on working capital. Okay. So here It will be 2986.1 minus 2760.0. Okay, so this is the cash inflow. All right. So now coming to cash flow from operating activities for year one, this will be equal to the sum total of all of these, right? So here it comes out to be 12464.1. Okay. Now I can easily copy and paste this across for the other years as well. And we now have completed cash flow from operating activities. Fine. Now let's go ahead and look at capital expenditure. Now, did we calculate capital expenditure? Do we have that number already? Yes, we already have that number. And where exactly it is found? It's found in this depreciation capex schedule, right? So you remember we have these numbers, and these numbers were coming from the management's discussion and analysis section, right? So let's now link this up. Now, important thing to note here is that this has a positive sign here. Okay. So though it has a positive sign within depreciation and capex schedule, but the thing is when it comes to cash flow statement, you have to represent it as a cash outflow because capital expenditure, right? You're making an investment in buying assets. So here, when you bring it, you'll bring it with a minus sign. Okay. With a minus sign here. All right. So that's what I'm doing here. I'm bringing it with a minus sign, minus 10,000 for year one, and so on and so forth for the other years as well. Okay. The next we have is addition to intangibles. Now, in order to understand addition to intangibles, let me go back to this balance sheet here, right? Now, intangible assets were zero earlier. Okay. And the broad idea will be that when it comes to forecast, we see historically it has never happened, so it will continue to behave in that similar way. So here we are going to assume that it's going to be zero going forward as well. So maybe we'll just keep it as the previous line. All right. So we are assuming that intangible assets are going to be the same and it's equal to zero for the future years. Okay, so when it comes to addition to intangibles, again, that will also be zero as such. But again, we know it is zero. It's always good to link to the balance sheet so that it works in an integrated way. Tomorrow, if you change these numbers, the links should automatically function and behave as it should, right? So the formula here will be actuals 3 minus year 1. So 0 minus 0, anyways, the answer will be 0. But the idea is if there is some number here, then it should come as an outflow. So therefore, I am subtracting actual 3 minus year 1. Okay. So it comes out to be 0. All right. And let's now complete this cash flow from investments. So this comes out to be minus 10,000 and copying and pasting across for the other years as well. Okay. Now, the last thing that we have is proceeds from and repayment of term loans. Now, obviously, we have not discussed the debt part, right? So, all of these numbers are going to come from the debt schedule. But for now, we'll just put the formula like this. Okay. We'll assume that this is going to come in the future and this function will automatically take care of the proceeds and repayments of term loan. Okay. Now, when it comes to the completion of cash flow statement, like the way we did in the income statement as well, we left these things, right? And then went ahead and calculated the net income. I would like you to do the same thing. We leave this, okay? And I want you to calculate the net change in cash and find the ending cash balance. Okay, so let's do that here. The net change in cash is nothing but your cash flow from operations plus cash flow from investments plus the cash flow from financing activities, right? So this will be the net change in year one. Okay. Let's copy and paste this for the other years as well. So we have the net change for all the 5-year period. Now, the next thing that we note is that in year one, we are getting this 2464.1 as a positive change, right, in cash. At the start of the year, you would have had certain amount of cash, right? So that will get added up in order to find the ending cash balance, right? So what we do is we put the formula like this. Ending cash balance is actually found exactly in the balance sheet here, right? So this is the ending cash balance for the previous year, 1400. So I'm linking it from the balance sheet. Okay. Now this ending cash balance of the previous year will become the beginning cash balance for this year, right? So as of 31st of December ending, let's say calendar year ending, is 1400. So as of 1st of this January, right, the next day, the morning, the beginning balance will be exactly the same, right? So that's what I'm assuming, 1400 here. So the ending balance will be equal to the sum total of these two, 2464.1 plus 1400. Okay. So with this logic, what we'll do is we'll copy and paste this formula here across, and year end of 1, like this 3864.1 as an ending cash balance, will become the beginning cash balance for year 2, and likewise so on and so forth, and we'll be able to find the ending cash balance for all the years, right, with the help of this. Step number 8, projecting debt, and step number 9, integrating the three statements and balancing the balance sheet. So only last two steps. So let's get started with step number 8. And for that, I'll go back to this sheet here. And in our previous tutorial, we looked at cash flow statements, right? And now we're going to project the debt items, right? But before we do that, one mini step that we have is that we need to complete the balance sheet items as well. So in most cases, when you see this balance sheet items like cash and cash equivalent, account receivables, etc., we've already projected them, right, in different sheets. But we need to link them here so that they are fully complete. And once this is done, we can move to the debt schedule. Okay, so let's complete this first, then go to the debt schedule. So let's get started with the asset side, and from the top, cash and cash equivalent. Did we project cash and cash equivalent numbers at the end of each of these years? Yes, we did in the previous step, right? These are the ending cash balances for each of these years. So the easy thing for us to do is just link it. So that's what I'm doing. 3864.1 for year 1, and so on and so forth. How about account receivables and inventory? Do we have these numbers? Yes, we have, because we have already done that in the working capital schedule. Okay, so let me quickly link this up as well. Working capital, account receivables, and the other item was inventory. Okay, so I'm linking these, right? So I have completed my forecast for total current assets, right? Now coming to the net PPE, property, plant and equipment. Did we forecast this? Yes, we have done that because we have already figured that out in the depreciation capex schedule. These are the year-end balances, right? And that's what will go in the balance sheet. Okay. So I'm linking that up here. All right. And copy and paste. So you can see that, these are color coded as green because these are coming from different sheets. Okay. Now, goodwill. Now, this is an interesting thing. And for that, let me just go back to the case study and see if there are things which are mentioned related to goodwill here. Okay. So let's scroll up. Okay. Here we have something like goodwill impairment. So, first thing first, you need to understand why goodwill actually comes on the balance sheet. Goodwill actually comes on the balance sheet only when a company has done certain set of acquisitions. So, if there is a purchase price, like the company has paid a premium over and above the fair value of the assets, then that amount is accounted for goodwill. So, it comes under purchase method of accounting, but let's assume that, company has taken care of all that accounting aspects of it. Now, the thing is that once the acquisition has happened, the goodwill actually sits there as it is year over year. And there are consultants who basically conduct, tests to ensure and see that if goodwill has kind of, moved or kind of impaired. So, impaired would mean that is there a reduction in value of goodwill? And if there is any, then the reduction will be done on the balance sheet. So if there is no impairment, then you will have to keep that number as constant. So when we look at this Epic Solutions, right, we have this goodwill number 2400. Now going forward, we really don't know whether an impairment will happen in the future or not. Impairments are actually fairly common. Think of Nokia's acquisition by Microsoft, impairment, right? So it, I think, led to $7 billion of impairment for Microsoft. But at these type of things, you have to account for on the balance sheet. But here, we do not have any answers to it, right? So for now, what we will do is we'll assume that goodwill is not going to be impaired. It's subject to annual impairment test, and it's beyond the scope of equity analysts to actually do that. Okay. So here I'm just equating it to the previous year's goodwill. Okay. So with that, we have the total other assets value as well, and the total assets will be equal to 52389.3. Okay, so we have the total assets value. Now let's look at the liabilities. The total liabilities, first we'll start with the accounts payables. We have already figured that out in the working capital schedule, right? So here we have accounts payables. Okay, so linking that up and copying and pasting this link as well. Now, the term loan, this is what is going to come in the debt schedule, which we are going to just discuss. Okay. So, this is again kind of taken care of. Now, when it comes to this shareholders' equity section, we are, going to assume certain things. But let's go back to first the case study and see if there are some details available with respect to shareholders' equity. So, there is none here. So, what I'm going to do is, I'm going to assume two things. One is that common stock positions will not change, okay, and there will be no treasury stocks, means that there will be no repurchase of equity that's going to happen, like repurchase of shares or buyback of shares, which typically management does each of the years when they feel that the stock is kind of undervalued. So this is the assumption that I have used. Now coming to retained earnings, how is it effective? Now, retained earnings means the amount of earnings that you're going to retain in the company for future investments. Now, what is your annual earnings? Annual earnings are the net income, right? So this is 11003.2. Now, out of this, are you going to pay any dividends? If the company is not paying any dividend, this is the overall amount that gets retained within the system. Okay, so the formula here is previous year's retained earnings, the beginning balance, plus this year's earnings, right? This year's earnings, because net income is what belongs to the shareholders, this is the linkage, right? So previous year's retained earnings plus 11003.2, that's the net income. So here it becomes 2300 3.2. Okay. So your shareholders' equity will now become 24203.2, and your total liabilities and shareholders' equity will become 27189.3. Okay. So let me do one thing. I'll just copy and paste this formula across so that it is valid for all the other years as well. Okay. Now, I would like you to also understand one very important aspect of it is that there is this check here. Okay. This check basically ensures that total assets is equal to total liabilities and shareholders' equity. So it is zero for the historical years, and that's what is the expected, outcome. Balance sheet should balance, but the balance sheets are not matching here, right? The balance sheets are not matching because we have not yet put the numbers associated with term loan, and all of these numbers are going to come when we complete the debt schedule. So as of now, as you can see, the balance sheet is not matching. The idea of the integrated restatement model is to make sure that after we do all the cash flow linkages and the income statement and the balance sheet, this check here for future years should come to zero. Okay. So with that in mind, let's now go back to our debt schedule. So debt schedule is all about, finding out what's the ending balance of the term loan, which is needed in the balance sheet. We also need the interest expense, and we also need the interest income, right? So these are the three objectives of the debt schedule. So for that, before I link everything up, I would like to go back to the case study to see if there are any details available regarding the same. So here we have this detail, right? Debt repayment strategy of Apex Solution. Apex Solution is dedicated to enhancing its financial health through a financial disciplined approach to debt management. So the company has committed an annual repayment of $2 billion on its term loan, right? And when you read more, you'll realize that Apex Solution plans to issue 1 billion of term loan each year as well. So there is a issuance of 1 billion and then there is a repayment of 2 billion, right? So when it comes to thinking about the cash inflow and outflow, you're doing a repayment of 2 billion means outflow of 2 billion and 1 billion will be the inflow. So there's a net outflow of $1 billion and this has to get modeled within your debt schedule. Okay, so let's start by looking at this part here. So the typical way of creating the debt schedule is writing these things. You have a beginning balance, then there are issuances, and then there are repayments, and then finally we have the ending balance. Okay, so what I'll do is I'll first link the ending balance here for actual 3. Okay, so this is 25200. Okay, now this will become the beginning balance for year number 1, right? How much is the issuance? Issuance is $1 billion. So that will be equal to 1,000 million, right? So this is the issuance. What is the repayment? It's $2 billion, right? So $2 billion, it will come with a minus sign because it's a cash outflow. So minus 2,000. So what's the ending balance? The ending balance will be nothing but 25200. In fact, I can just write a simple formula. This will be sum total of these 3, right? So it comes out to be 24200. Okay. Now this 24200 will become the beginning balance for year 2, right? And this is the same situation which is going to continue for year 2 as well, right? So the ending balance here will become 23200. So what I'll do now is I'll copy and paste this across for the other years as well, so as to find the ending balances for each of these remaining years. Okay. So with that, we have the ending balance of term loan. Now, the next step is basically to find out the interest expense. So you know that interest expense is basically on the loan, right? So we have the outstanding amount at the start of the year. We have the outstanding amount at the end of the year, right? So the typical way to find out the interest balance is that we first figure out what's the average of these two, starting and ending, and then we multiply that by the interest rate that is applicable. We have been provided with the interest rate in the case study itself, and we see that the term loan interest rate is fixed at 9%. So here we have this number as 9%. I'll just put this across for the years or from year 1 to year 5. Okay. Now, going back to calculating the average outstanding, so this will be starting year and ending balance as well, right? So this will be the average outstanding balance for year number 1. So interest expense is nothing but your average outstanding balance 24700 multiplied by 9%. So this comes out to be 2223.0. Okay. And I can copy this across for other years so that we calculate the average balances for the other years too. And we can also calculate the expenses for the other years in a similar way. Okay. So I hope you understood how to go about calculating the interest expense. Now, let's look at the other side, interest income. Now, income is earned on the cash and cash equivalents which you have in the bank, right? And if you go back to the case study, you may note that there's an interest rate that is earned on cash deposit, and that is equal to 3%. Okay. So here, I'll put this as 3% across all the other years. And like we did in the case of average outstanding, right? We took the average of beginning and the ending. Again, we'll do the same for cash and cash equivalent that's going to earn interest income. So I'm going to put the formula like this: average, okay, and average of these two, okay, beginning balance and ending balance, okay, and bracket closed. So what do we get this number? This is 2632.0. Okay, so you can easily calculate the interest income now. This will be 2632.0 multiplied by 3%. Okay, so we get this interest income as 79. I'll just copy and paste this across for the other years and calculate the interest income for the other years as well. Okay, so with this, we have actually completed the full debt schedule. With step number 9, we'll be able to integrate everything, and our three statement financial model should work perfectly fine, right? So that's the objective, and let's get started here. We'll go back to this financial modeling template, and in our previous tutorial we looked at completing the debt schedule, right? Now coming to the other part of it, like integrating everything and linking the missing parts, right? So we'll go back to the income statement first. Okay, so we have the debt items, right? Interest expense and interest income, right? So let's link this up. Okay, so I'm linking this up because we already have these numbers. So 2223.0, this is the interest expense. Okay, so as you can see, these numbers are getting automatically adjusted. The net income has now reduced a bit. Okay, likewise, let me link the interest income. Okay, and the interest income here is 53.4 for now, so I'm linked here as well. Okay, so as you see that the linkages to the interest expense and interest income are now fully complete. I'll just unhighlight with no fill, and with this we have totally completed the income statement forecast. Okay, now coming to the balance sheet, right? So when it comes to the balance sheet, we see that the balance sheet, only one item was remaining, and that is term loan, right? And where will we find this number? We have already found this number in the debt schedule, right? So here we have, right, this is the ending balance. So let's link this up here. Okay, so I'm going to do that. This is equal to 24200 at the end of year 1. Okay, so I'm linking it here for the other years as well. Now as you see that when we complete this term loan, and when we look at the check here, the check says that the balance sheet has not balanced yet, right? The total assets are different from total liabilities to an extent of 1000 million, that is $1 billion, and then it increases to 2 billion, 3 billion, 4 billion, 5 billion. Why do you think it is so? The reason is that we have not yet completed the cash flow statement as well. You remember when we looked at the debt schedule, right? So there is this cash inflow because of issuance, and then there's a cash outflow because of repayment. So this item has to be accounted for in the cash flow statement as well, right? So if you go back to this cash flow statement, and when you see from the top to bottom, this is the place where we have not yet filled the details related to debt, correct? So let's link this up as well. So proceeds from and repayments of term loans. So here it will be cash inflow of 1000 and cash outflow of 2000. So the net amount is minus 1000, right? So let me press enter and see. Okay, so this is the outflow, right? Minus 1000 here. So I'll just copy this and paste it across for the other years as well. Okay, so we get this minus 1000 for all the years. So when we look at now the linkages, as far as all the links that are coming from different tabs are fully complete. Let's now look at the moment of truth, meaning the balance sheet, right? So now when I look at the balance sheet here for the future years, you see that the balance sheets actually balance, and once you reach this stage, you have fully completed your 3-statement model. By the way, congratulations, because this is the hardest step when it comes to financial modeling. We realize that many a times balancing the balance sheet becomes super difficult, and if you follow the steps like the way we did here in our financial model, this should not be a problem anymore. So your balance sheet will completely balance like the way we did here. Okay, now once you fully complete this financial model, I would like to highlight a couple of things here. We are calling this as an integrated financial model. An integrated financial model essentially means that you've done the forecast for the income statement, right? You've done the forecast for the balance sheet, and you've also done the forecast for the cash flow statement. Integrated financial model typically would mean that, let's say, if I change an assumption here and there, like for example, when it comes to revenues, right? If I change an assumption from, let's say, 20% to 15%, or maybe whatever number you think of, then the model should still be integrated and should work cohesively. So let me just do that. I'll just change 20% to, let's say, 15% here, okay, for all the years. Now let's see. Obviously, when it comes to this integrated model, the revenue numbers get automatically adjusted, the net income numbers get automatically adjusted, it gets flows through the cash flow statements, the cash flow items also get automatically adjusted, and the important thing to note is that your balance sheet will have a new number here, but they are still balanced, right? So even you change certain set of assumptions here and there, your balance sheet will still work in an integrated fashion. So that's why it's called as a three statement integrated financial model. Okay, so I'll just revert this back to 20%. Okay, and the next thing which I just wanted to highlight and make you understand is that once you complete the financial model, you should also try to do some of your analysis on how future financials are going to look like for example, when it comes to the profitability. Okay, now the profitability was 50.8, 35.3, with the respective items here. What I can do is I can copy and paste this across for the future years and observe the trends, right? So if this is out of sync or out of line, you will know how your predictions are. So if, let's say, this was coming out to be 90%, and just for argument's sake, so obviously your financial model may not be correct, right? So you have to kind of also understand and figure out how the EBITDA margins and all the EBIT margins, net income margins are going to perform in the future. And doing these kind of analysis, the profitability analysis and the ratios which we calculated in the balance sheet, becomes super important. So let's do that here as well. I'll just copy this and paste it for future years, and let's see how these numbers look like. So current ratios is kind of increasing every year, and the reason could be because your cash is kind of increasing at a much faster pace. Now when it comes to understanding of why cash is increasing at a faster pace, we'll have to go back and debug and look at the cash flow statements, right? So what we are seeing here is that cash flow from operations is a very high number. It's 23448, right? And cash flow from investments and financing is a very low number. So each year keep on adding a very high number. So in just year 5, you have added $7.448 billion in cash, right? So that's the reason your balance sheet cash and cash equivalent items are inflating. Okay, so these are the type of exercises or analysis you should kind of think of and continue to do. So with that, we basically come to the end of this financial modeling tutorial. As you understand that financial modeling is actually the backbone of all the decisions that you're going to take in finance, and financial modeling has importance in investment banking, equity research, credit research, portfolio management, you name it. And this is the most important and critical skill that you need to understand and learn and master if you want to make a career in finance. So what next? I would suggest that you keep on practicing and practicing and practicing with real world scenarios and try to create a own financial model. And in fact, I have two most important resources for you. If you refer to those, you will again get more ideas on how to go about creating a financial model, and you can easily jumpstart your career in these type of core finance areas. So the first one, which is the resource we have, is financial modeling in Excel tutorial. And this time we have created financial model of a real life company, that is Colgate. So here you have all step-by-step instructions on how to create a financial model of a company like Colgate. So the way you were following the tutorial with me here, right, you can follow the tutorial here as well. And we have shown you each and every step of linkages to going about doing the financial model of a real life company like Colgate professionally. Okay, so that's approach number one. You can practice by doing it on Colgate. And another thing that you can also look at is that if you want to jumpstart your career more professionally, you can learn from us. We offer various courses on financial modeling, and primarily you have two variations which are available. One is the self-study mode, where we have created tutorial on McDonald's financial model. So it's a full 14-hour tutorial where we start from scratch. We download McDonald's annual report, to dissecting each and every element, to copying and pasting it to the historical. So these 9 steps which we just learned in financial modeling, it goes much beyond that as well, because this is more advanced financial modeling which I am talking about, because it's real life applications, right? So that's self-study mode. The other mode is that you can opt for live classes. So we conduct live classes every month on financial modeling, and you can attend that as well. So in live classes, we take some advanced portions of financial modeling and we try to create a financial model from scratch. And obviously you have an opportunity to ask questions to us, and typically these live classes are taken by experts like me. This brings us to the end of this 9-part series on financial modeling in Excel. One final request: like, share, and subscribe. Please show your support by giving these set of videos a thumbs up, and hit the subscribe button as well, and turn on the notification bell so that you do not miss any upcoming content from our side. And finally, please do share this series to your friends, colleagues who want to level up their game in financial modeling. Definitely your support inspires us to create this high quality content, and it keeps this journey going alive, right? So let's grow together as finance professionals. Thank you for being a part of this journey. I'll see you in the next video.